The global financial system is built on one fragile idea: trust. And tonight, that trust is being tested in a way many experts once said would never happen. Major Chinese banks are quietly pulling away from United States dollar assets, even as Washington moves forward with a decision that changes the rules of global money forever. This is not rumor, this is not speculation. This is happening now, and the consequences could reach every country, every bank, and every currency tied to the dollar. For decades, the US dollar has been treated as untouchable, safe, neutral, above politics. Countries stored their wealth in dollars because they believed one thing: no matter who you are, your money is secure. That belief is now cracking. The United States has taken frozen Russian reserves and begun redirecting them, turning idle money into a political weapon. To many governments watching closely, this crossed a line that cannot be uncrossed. China noticed, and China understood the message clearly. Behind closed doors, Chinese state-linked banks have started reducing their exposure to dollar-based assets, including U.S. Treasuries, dollar reserves, and long-term financial instruments that once defined global stability. These moves are not loud. They are not announced on television. They are careful, strategic, and deliberate, and that silence is exactly why they matter. This is the unthinkable moment, the point at which the world's second-largest economy begins acting on a fear many countries share but rarely admit. If one nation's reserves can be seized and repurposed, then no reserve is truly safe, not today, not tomorrow, not ever. That realization is forcing powerful financial institutions to rethink everything they thought they knew about security, sovereignty, and control. In this video, you will learn why China views the seizure of Russian reserves as a direct warning, not a distant event. You will understand what it really means when banks begin quietly reducing dollar exposure, and why this does not happen overnight but through incremental steps that reshape markets over time. You will see how the weaponization of money changes global power, and why this moment could mark the beginning of a slow but historic shift away from dollar dominance. We will also break down the lesser-known mechanics behind reserve assets, why confidence matters more than force in global finance, and how even small changes in trust can trigger massive long-term consequences. This is not just about geopolitics. This is about savings, stability, and the rules that govern the world economy. Stay with us until the end, because the final takeaway explains why this decision may cost the United States more power than it gains, and why other nations are now quietly preparing for a future where money is no longer neutral. Welcome to our channel, where we break down the forces shaping the global economy without noise or distraction. If you value clear analysis, deep context, and stories that go beyond the headlines, subscribe now and stay with us. Over the past year, the United States and its allies froze hundreds of billions of dollars belonging to Russia's central bank. These funds were not private money. They were national reserves, including cash, bonds, and foreign currency assets that Russia had stored in Western financial systems for stability and trade. Until recently, those reserves were frozen but still legally recognized as Russian property. That line has now shifted. Washington has approved a framework allowing income generated from these frozen assets to be redirected, and in some cases lays the legal groundwork for the assets themselves to support Ukraine. In practical terms, interest earned on Russian reserves held abroad can now be collected and transferred without Russia's consent. Money that once sat idle as a neutral store of value is now actively repurposed for political and strategic goals. To understand why this matters, it is important to clarify what seized reserves actually are. Central bank reserves exist to protect a country during crisis. They stabilize currencies, support liquidity, and reassure markets that a nation can meet its obligations. These assets are usually placed in foreign banks and government bonds because they are considered safe, liquid, and protected by international norms. When those norms hold, reserves act as insurance. When they break, reserves become vulnerable. This decision goes far beyond punishing Russia. It changes expectations for every country holding assets in another nation's financial system. The message is not only about sanctions, it is about control. If reserves can be frozen, managed, and redirected based on political alignment, financial safety is no longer guaranteed by law alone. It becomes conditional. Many governments understand that Russia is a unique case, but they also understand precedent. Financial systems operate on assumptions, not just rules. Once a major reserve currency is. Euro demonstrates that sovereign assets can be used as leverage, other nations must reassess their own exposure. This applies to rivals, partners, and even allies. One detail often overlooked is timing. This decision comes at a moment when global debt is high, trust between major powers is low, and alternatives to the dollar system are slowly expanding. Even small policy changes in this environment carry amplified consequences. Markets may not react immediately, but central banks do not think in days or weeks, they think in decades. The United States still holds enormous influence in global finance, but influence depends on confidence. By moving from freezing reserves to actively using them, the United States has introduced a new variable into the global system, one that forces other nations to quietly reassess how, where, and in what form they store their national wealth. China has spent decades building one of the largest foreign reserve stockpiles in the world, and a significant portion of it is still tied to US dollar assets. These include government bonds, dollar deposits, and other financial instruments linked to the American system. This exposure was not accidental. For years, the dollar offered liquidity, stability, and global acceptance, allowing China to manage trade flows, stabilize its currency, and protect itself during economic shocks. But the situation with Russia changed how that exposure is viewed. From Beijing's perspective, the issue is not political alignment, it is structural risk. Russia's reserves were held abroad under the same assumptions China follows, in what were considered neutral, rules-based systems. Once those reserves were frozen and partially redirected, Chinese policymakers saw a scenario they had modeled only in theory become real in practice. The country holding the reserve currency also holds ultimate control. China does not see itself as Russia. Its economy is larger, more integrated, and deeply linked to global trade. But that is exactly what makes the parallel unsettling. Greater integration means greater exposure. If geopolitical tensions escalate, financial interdependence becomes a vulnerability rather than a shield. The lesson is simple and uncomfortable. Access to reserves depends not only on ownership but on approval. There is also a deeper fear tied to sovereignty. Foreign reserves are supposed to be a nation's final line of defense. They exist for moments of crisis, when markets turn hostile or supply chains break. If those reserves can be restricted or repurposed by another government, their function changes entirely. They stop being protection and start becoming leverage held by someone else. This forces a tension between trust and control. The global financial system relies on trust that rules apply equally, yet control sits with the countries that issue reserve currencies and host financial infrastructure. China has long accepted this imbalance because the benefits outweighed the risks. The Russian case altered that calculation. Control was no longer theoretical, it was exercised openly. Another factor is signaling. Beijing understands that actions taken against one country are watched by many others. Financial power does not need to be used often to be effective, it only needs to be used once clearly. That clarity triggered internal reviews within Chinese financial institutions, central planners, and major state banks. These reviews are not about panic, they are about reducing exposure over time. In global finance, trust takes decades to build and moments to weaken. China's alarm is rooted in the realization that trust alone may no longer be enough to protect national wealth stored beyond its own borders. China's response has not come through speeches or official declarations. It has moved through its banking system, where decisions are made quietly and executed gradually. The center of this response lies with state-owned banks. These institutions do not operate like private banks in the West. They are closely aligned with national policy goals and often act as extensions of long-term government strategy rather than short-term profit seekers. When these banks adjust their exposure, it reflects direction from the top even if no public order is announced. Changes are spread across balance sheets, trading desks, and reserve management operations. The goal is not to shock markets, it is to reduce risk without drawing attention. This is why the response appears slow on the surface but is significant underneath. The phrase dumping US dollar assets can be misleading. It does not mean selling everything at once, that would be costly and disruptive. Instead, it involves reducing new purchases, letting existing bonds mature without replacement, and shifting excess reserves into other currencies or assets. Over time, this quietly shrinks dollar exposure without triggering panic or price collapses. To understand this better, it helps to simplify the instruments involved. D-bonds and treasuries are loans made to governments. When China holds U.S. treasuries, it is effectively lending money to Washington in exchange for interest and safety. Reserves are savings held to defend a currency and support trade. For years, the dollar served all these purposes efficiently, but that is now changing. Now the concern is not return, but access. State banks manage massive portfolios that include government debt, foreign currency deposits, and cross-border investments. Adjustments within these portfolios happen in many small steps. A bond that matures may not be rolled over. A new reserve allocation might favor a different currency. A trade settlement could avoid the dollar where alternatives exist. Each step alone seems minor, but together they represent a strategic shift. Another critical detail is messaging. Public announcements can trigger market reactions and political responses. Quiet moves avoid headlines, preserving flexibility. Chinese banks can reverse course if conditions change or accelerate adjustments if risks increase. This silence is intentional. It keeps options open while signaling seriousness to those paying attention. Coordination also plays a role. Major state banks often move in parallel even without identical actions. This creates a steady, controlled adjustment rather than a sudden break. Smaller banks and financial institutions tend to follow the lead of these giants, amplifying the effect over time. None of this happens overnight. Reserve diversification is measured in months and years, but the direction matters more than the speed. The response inside China's banking system shows how financial power can be exercised without confrontation, using balance sheets instead of statements and patience instead of pressure. These adjustments fit into a broader trend known as de-dollarization, a slow, deliberate effort by many countries to reduce dependence on the US dollar for trade, reserves, and finance. This trend did not begin with Russia, nor did it begin this year. It has been quietly building as geopolitical tensions have risen and financial tools have become more politicized. For China, de-dollarization is not a reaction. It is part of a long-term strategy that has unfolded over years. Beijing has worked to expand the use of its own currency in trade settlements, especially with energy exporters and regional partners. Swap lines have been established with other central banks, allowing trade to continue without touching the dollar system. Payment infrastructure has been developed to reduce reliance on Western networks. Each step was small, technical, and easy to overlook. Over time, a clear pattern emerges. China gradually reduced its share of U.S. treasuries and reserves, increased gold holdings as a neutral asset, encouraged commodity contracts priced in local currency, and promoted regional trade agreements minimizing dollar use. Individually, none of these moves caused disruption, but together they laid critical groundwork. What makes the current moment different is speed and motivation. The seizure and redirection of Russian reserves compressed timelines. Risks that once seemed distant became immediate. Strategic plans that could have taken decades are now being reviewed urgently. When financial norms change, preparation quickly turns into action. Another factor accelerating the shift is alignment with other countries. China is not alone in reassessing dollar exposure. Several economies, both large and small, are exploring similar paths, even for different reasons. This creates reinforcement. When multiple players move in the same direction, the cost of change falls and the confidence to act rises. Coordination does not require formal alliances. In global finance, shared incentives are enough. When the same risk is recognized across borders, similar responses emerge naturally. Systems evolve without visible leadership. Technology plays a role as well. Digital settlement systems, alternative clearing channels, and local currency trade mechanisms are far more developed than a decade ago. These tools reduce friction and make diversification practical rather than theoretical. What once required trust now requires only access. The result is a shift that appears gradual but carries momentum. Each policy choice, each reserve adjustment, and each trade settlement decision feeds into a larger transformation. This moment accelerates everything because it confirms a fear many had quietly held, and once confirmed, hesitation disappears. From Washington's perspective, the decision to use Russian assets was not made lightly. It emerged from strategic calculation, political urgency, and confidence in existing financial dominance. The United States viewed the frozen reserves as a rare source of leverage, one that could be applied without deploying troops or escalating direct conflict. In this logic, money became a tool of statecraft, capable of imposing costs while supporting it. Ally under pressure. There was also a practical consideration. Supporting Ukraine required long-term funding, and domestic political appetite for endless aid packages was beginning to strain. Redirecting income from Russian reserves offered a way to sustain support without asking voters for more tax dollars or additional borrowing. The move was framed as accountability rather than punishment, reinforcing the narrative that Russia would bear the financial burden of its own actions. Political pressure played a central role. Lawmakers faced demands to act decisively and visibly. Freezing assets alone began to feel symbolic over time. Using them signaled resolve and leadership, both to allies and domestic audiences. In moments of conflict, inaction can be perceived as weakness, especially when tools are available. This momentum pushed policymakers toward a bolder step, even if the long-term effects were uncertain. Financial consequences, however, operate on a different timeline than political rewards. Markets and central banks respond slowly, adjusting portfolios over years rather than reacting to headlines. This gap allows short-term gains to feel manageable while deeper risks remain abstract. The immediate benefit was clear, the long-term cost, erosion of trust, was harder to measure and easier to discount. Another factor was confidence in the dollar's position. The United States has long benefited from the dollar's central role in global trade and finance. That dominance created a sense of insulation. Policymakers assumed alternatives were limited and that other countries had few viable options at scale. This belief reduced perceived risk. If the dollar is unavoidable, leverage can be applied without fear of exit. Power projection also shaped the decision. Demonstrating the ability to control assets across borders reinforces influence and shows that financial infrastructure is not neutral, it is governed. The message was intended not only for Russia but for anyone considering challenges to the existing order. It emphasized that access to the system comes with conditions. Yet power projection carries trade-offs. The same action that deters one actor can alarm others. Using assets as a weapon clarifies who holds authority, but it also exposes dependence. Observers are forced to reassess their own exposure even if they never plan to confront Washington directly. In this framework, the decision reflects a familiar pattern. Immediate strategic advantage outweighed distant structural risk. The benefits were visible, measurable, and politically valuable. The costs were diffuse, delayed, and global. Outside the public spotlight, governments and financial institutions worldwide have studied the U.S. decision carefully. Official statements remain restrained, but private discussions reveal a different story. For many countries, this was not an isolated sanction tied only to Russia. It was a signal about how power now operates in the global financial system. The first response has been analytical rather than emotional. Finance ministries and central banks began asking internal questions about exposure, legal protection, and access. These reviews focus on where reserves are held, under which jurisdictions, and in what form. The goal is resilience, not confrontation. Countries want to understand how quickly assets could be restricted if political relations shift. There has been a noticeable increase in silent reassessments of dollar reserves. This does not mean sudden selling, it means stress testing assumptions that have been in place for decades. Officials are examining whether reserves still serve their original purpose. Liquidity and safety remain crucial, but so does control. The balance between these priorities is being recalculated. Banks play a critical role. Large international banks manage reserve assets, facilitate settlements, and provide access to global markets. Their risk teams are reviewing scenarios that once seemed extreme. Questions about asset freezes, legal reach, and cross-border enforcement are no longer hypothetical. These discussions rarely leave boardrooms, but they shape long-term strategy. Central banks are equally attentive. They operate on trust and predictability. When rules appear to shift, even for justified reasons, central banks respond by diversifying options, currency composition, maturity profiles, and asset classes. Such changes are slow and technical, designed to improve flexibility without disruption. Governments also monitor each other. Financial behavior is contagious. When one major economy adjusts its reserves, it sets a reference point. When several do so independently, it forms a trend. Policymakers watch these signals closely, aware that acting too early or too loudly can carry risks. Importantly, there is no panic. Markets have not collapsed, currencies have not unraveled. That stability can be misleading. Deep concern often expresses itself through patience rather than urging. Why institutions built to manage crisis prefer quiet preparation to visible reaction. The absence of headlines does not indicate indifference, it reflects caution. Many countries are choosing to observe, evaluate, and adapt quietly. In global finance, silence often marks the moment when assumptions are being rewritten, even as daily operations continue unchanged. The US dollar maintains its dominant position for simple reasons. It is widely accepted, deeply liquid, and backed by the world's largest financial markets. Governments use it to trade, borrow, and store value because they know others will accept it without question. This dominance was not built through law or enforcement. It emerged through consistency, reliability, and long-standing trust in the system behind it. Force alone cannot sustain a reserve currency. Confidence does. Countries hold dollars not because they are required to, but because doing so feels safer than the alternatives. The moment that calculation shifts, even slightly, behavior begins to change. This does not require hostility or rebellion. It starts with caution, small adjustments, and quiet diversification. When trust weakens, the effects are subtle at first. Fewer new purchases of dollar assets, more exploration of alternative settlement methods, and increased interest in other currencies or neutral stores of value. These moves rarely make headlines, but they accumulate over time. Reserve managers are trained to avoid concentration risk. Trust is a form of concentration, and once questioned, it is reduced. The dollar's strength has always rested on the belief that it operates above politics. Assets held in dollars were assumed to be secure regardless of disagreements. When that belief is challenged, the dollar does not lose value overnight. Instead, its unique status begins to blur. It becomes one option among several rather than the default choice. There is an important distinction between erosion and collapse. Collapse is dramatic and fast. Erosion is quiet and persistent. History shows that reserve currencies tend to fade through erosion, not sudden failure. Trade patterns shift, financial infrastructure adapts, and alternatives become more viable as usage grows. Each step reinforces the next. The current concern is not that the dollar will disappear, but that its margin of safety is narrowing. With less unquestioned confidence, the system relies more on incentives and pressure, increasing volatility and reducing flexibility. A currency that once absorbed shocks easily becomes more sensitive to global shifts. As trust becomes conditional, decisions once made automatically now require review. That alone changes behavior. Even if the dollar remains dominant, the conditions of that dominance evolve. In global finance, evolution matters as much as revolution. The recent actions surrounding Russian reserves have highlighted a larger truth about global finance. Money itself has become a weapon. Assets are no longer neutral tools for trade or storage. They can be seized, redirected, or restricted, and the consequences ripple far beyond their immediate use. When a country controls the flow of international capital, it can influence decisions, shape alliances, and impose costs without firing a single shot. This is power in its most modern form. Financial leverage is now central to geopolitical strategy. Countries with significant holdings in foreign assets can sway markets, signal priorities, and create economic pressure. This goes beyond sanctions. It is about demonstrating control over the rules of engagement in global economics. Governments, banks, and even private institutions must consider how their exposure might be used not just for profit, but for strategic influence. One of the most significant consequences is the fragmentation of the global system. The world is slowly dividing into financial blocks. Dollar-centric nations maintain tight integration with American systems, while China, Russia, and other emerging powers explore alternatives to reduce reliance on these networks. These blocks are defined not only by ideology, but by the choice of currency, clearing mechanisms, and reserve holdings. Trade, investment, and lending increasingly reflect these alignments, creating parallel systems that coexist uneasily. Neutrality in finance is fading. Assets once seen as tools of stability are now instruments of leverage. Decisions once purely economic are now interpreted politically. Banks and central banks previously considered impartial intermediaries must reassess their roles in a world where holding or moving money can send a clear message about loyalty, risk tolerance, and strategic positioning. This shift also impacts smaller nations and institutions. Even those outside the major powers, calculations must consider which bloc their reserves align with, which trade networks they use, and which financial partners they trust. These choices are no longer purely technical, they carry implications for influence, access, and protection. Digital finance and alternative payment networks accelerate this change. Countries can bypass traditional systems, create bilateral settlement arrangements, and reduce exposure to dominant financial infrastructures. Each technological innovation reinforces the trend toward segmentation. Over time, this creates resilience for some and vulnerability for others. The outcome is a world where financial relationships are explicitly tied to power. Money is no longer just a medium of exchange, it is a form of strategic leverage. Countries, institutions, and corporations must navigate this landscape carefully, recognizing that the distribution of assets and reserves can determine influence as much as military strength or political alliances. Trust is no longer universal, and every transaction carries implications beyond the immediate balance sheet. This is not about Russia alone, it is not even about China alone. It is about a world where money can be turned into power, where savings are no longer neutral, and where financial decisions carry political weight. Every reserve, every bond, every asset now exists in a landscape where trust can shift overnight. How long can any nation rely on the safety of its wealth when control is held elsewhere? If this raises questions for you, we want to hear your thoughts. Do you think the global financial system can survive this shift, or are we entering a new era of monetary power struggles? If you found this analysis insightful, make sure to like, share, and subscribe to our channel. Stay with us for more in-depth breakdowns on the forces shaping our global economy.